Welcome back, everyone, to Vox Markets Live. My name is Paul Hill, and I'm delighted again to be able to speak to equity analyst and stock markets commentator Paul Scott to discuss all things small caps. So, big welcome, Paul.
Hello, Paul. I didn't hear that our lovely theme tune then. Have you pressed the right button?
Yeah, no, we started live, and I was thinking, where's that music gone? Okay, so I don't know whether we're jinxed today. We've been jinxed last week, so fingers crossed that we won't have any technical problems this week.
Yes,
anyway,
fingers crossed.
It's great to have you on this side of the channel, given the ongoing war in the Middle East. We've got a quick question straight out the gate, actually. We've got Andrew Haslam. He's saying, is there any sectors you would say that would be, basically should benefit from the Iran war other than obviously defense?
Well, I don't really look at investing that way. I'm more medium, long-term, company-specific. So no, I'm not trying to play short-term market movements. I'll leave that to traders.
Okay. I would just say two ones to look at would be obviously oil and gas. I mean, anybody who's not producing in the Middle East should do well. The US oilers and North Sea generators should do well with a higher oil price. And then I would also say, which is sort of counterintuitive, there was quite a good bellwether airline out in the States 2 days ago, Delta. They actually produced some surprisingly good results. The actual shares went up about 10%, basically saying that they've actually, since this war happened 3 weeks ago, they've had a deluge of people front running the future prices, and therefore all of those potential late bookings that they were anticipating have now hit them in the last 3 weeks as people want to get ahead of this potential increase on prices. So I think the likes of, I know you love it there, Paul, Jet2, EasyJet, IAG. I would strongly have a look at those because I think they're going to surprise to the upside because the shares are absolutely in the toilet at the moment.
That's a really good point, actually. We've been having discussions on this on my Substack. I think you were discussing it with someone else. We've had Ryanair has publicly, not an RNS, but they've said precisely that. They're short haul European. They've had a deluge of bookings. But then we had Wizz Air actually put a profit warning out saying that it's been hit by its relatively small Middle Eastern exposure. So at the moment, we're not quite sure. But yeah, I'm definitely with you. I think Jet2 and EasyJet have fabulous balance sheets, and they should benefit, if anything, from more holidays. And like you say, people saying, well, oil's getting more expensive, let's lock in our airfares. So yeah, we're guessing, but I think probably more upside for EasyJet and Jet2 than downside, but the shares are 15-20% cheaper. So what's not to like?
Yeah, I agree with you. Okay, we've got plenty of bargains. We've got another one potentially. We've got Simon Rowan and Drew both asking about Eleco, which is one I've owned for 10 years, and they're both saying this share price downside is absolute bonkers. I don't know if you got any quick thoughts. I've got plenty I could add on to it.
Yeah, I mean, you're the expert on this one, Paul. Obviously, you know it way better than me. I did look at it the other day because it came up on a big fallers list. I mean, I think we're going to have to agree to disagree on this, but I think the whole sector has gone from overvalued to priced about right. So for me, forward PE is nearly 20 times. I think that's, like I say, I think that's about right.
Yeah, I mean, we are going to disagree on this one. I mean, it's come down to 1.7 times sales for a profitable SaaS business that's growing at sort of like low double digits or sort of 10, 11% SaaS revenues. It's been hit by two things. One, obviously, the worries about whole things of AI disintermediation on the software. You've got to remember this is pretty much entrenched in the building sector because it isn't just people who design it. It's the guys who actually then at the coalface, your people at the site actually needing access to see real-time information, whether how high the walls have gone up, whether they're putting the right materials in. So it gives them that digital twin of what's actually been renovated. So it's pretty much entrenched within their clients. So I don't think it's going to be. I actually think it's going to be a beneficiary of agentic AI on that basis because it can put more service and increasing its addressable market. It's also been hit by this whole sell-off in construction. People have actually think everything in building products, construction is going down the pan. Well, this happened back in 2016 when we had the Brexit vote, and actually the share price went down by about 50% because everybody thought nobody was going to invest in property in the UK, and actually the business did phenomenally well. It was so resilient, so I don't think that they'll have any problems. In fact, if anything, I think more of the house builders are actually implementing exactly the type of software. In fact, when I spoke to the CEO at the trading update last month, he was saying he's getting a deluge of inquiries from the house builders because they need to improve their systems on the site management. And then the third bit is just the general sort of malaise in terms of, you know, the higher oil price and Middle Eastern worries, and you get lots of goods. I think enterprise software now is a really good sector, and the reason is, you're seeing almost like generational multiples, and you've got to remember there's a massive gap between standalone valuation, which is exactly what Paul's looking at 20 times PE for a standalone business on a business that, you know, is growing earnings at sort of like, you know, high teens. It's a peg of one. It's about fair price. But the thing is, the difference is a takeover valuation. This to a strategic buyer is basically 90% gross margins. You would just drop down to the bottom line. Admittedly, yes, there are some things that are variable, like some variable sales expenses and stuff like this. But frankly, the strategic value of M&A, and I think a lot of our crown jewel software stocks in the UK are going to people going to put a slide rule if we're stupid enough to sell them. And I think this is a great buy. It is actually now, because all the software companies have come down. It's about the fact that it's either my biggest stock or just my second biggest. It's one of the two. It's this one or Active Ops, and I think it is bonkers. And if you're a long-term investor, which I am, which have held it for a decade or more, then you know, I think it's a good entry point. But you have to make that decision yourself.
Yeah, I like it. Don't get me wrong. I'm positive on the company and the fundamentals. I think they're very good. I think the only thing we slightly disagree on is valuation. So for me, probably priced about right. Not, you know, I just think there's better bargains at the moment out there with so many things that have been sold off. But yeah, as you say, for long term, I'm looking at the graphs here of its long-term performance over the last 10 years. Very, very impressive. Very good business. No arguments over that at all.
Good. Okay, well, let's move to one we have got a bit more M&A on. We've got CAB Payments. Now, I know you don't like the business, but let's not talk about the business. It's basically international payments, foreign exchange type business, largely for frontier markets and emerging markets to help relief causes and relief aid get money out there and stuff like that. Anyway, they've had two interesting videos. We've talked about it before about a month ago with Helios, their largest shareholder, 45% stake. It's now been topped out by StoneX, which has come out at 95p versus Helios's 85p bid. Unbelievable to a certain extent. What's your view whether this is going through? Because, yeah, I mean, we've seen this movie with Treat and with Auction Technology.
Yeah, I think we had StoneX sniffing around this or another payments company some time ago, didn't we? So, I mean, it's always lovely for shareholders if you have several bidders circling the company that you hold, isn't it? I mean, you can get some very nice outcomes on it. I mean, for me, it's just not something I would invest in, irrespective of bids and whatnot. So I haven't really got anything to say, other than that we had the statement on the 16th of March, 2 days ago, was from StoneX. I've not seen any response from CAB-P. Have they issued one yet? Do you
No,
know?
they haven't, other than just saying that they're assessing that bid. Yeah. They haven't rejected
so they haven't rejected it. Well, that's quite interesting, isn't it? Yeah. Well, good luck to holders is all I can say, but it's not something I follow closely. I'm not touching any of these payment companies ever again.
Yeah. Just more generally, though, I mean, the interesting bit here is that you've got an outside bidder who I don't think is a shareholder in StoneX going ahead with a bid where the biggest shareholder has 45%. In fact, I think it has sort of like almost like 50%. Why are they doing this? Because you'd think it's just going to get blocked, isn't it? It's a really weird. I don't think I've ever seen in my 30-year history, you know, of stock market, somebody coming over the top where a previous bidder has already effectively got half the share.
Yeah, that's a really good point. Yeah, I didn't actually realize that Helios owns 45%. So yeah, it's a strange thing because they can't force through StoneX can't force through a bid, can they? So why would you go public? You'd either agree it with Helios in private and then announce it as a done deal. But yeah, sort of going over the top. I mean, maybe they're just trying to put pressure on Helios and want other shareholders to, but they can't force the situation, can they? So
You don't usually get a third party deciding to put pressure on, the existing shareholder, do you?
No, not a 45% shareholder. I agree. So who knows? We need to bug the offices of these various companies and find out what's going on, don't we?
My only take is that what happens in a lot of these movies. Look at what D-Bay's done in the past, okay? Because it takes usually D-Bay, just for people's understanding, is a private equity house that takes sort of 25 to nearly 30% interest in a lot of companies, and then when they're interested in buying, and then when there's a bid, sometimes it joins the concert party with the trade buyer. And doesn't sell out. It moves its shares into a vehicle. And I think the only reason why StoneX has done it is actually, it's an olive branch to Helios to say, look, we can do this together at 95. Because I don't see any motivation otherwise for them to do it. It just seems bonkers.
Yeah, no, very interesting to speculate on this. I agree. Yeah.
Okay, one you've been all over in the past. System One Advertising. These guys basically do software that helps corporates predict the sort of like the results of their advertising campaigns before they do them, to give them an indication of what the actual success is going to be. This stock in its trading has been all over the shop. Anyway, can you take us through their current performance, because it was going horrible and then it's sort of come back well.
I know, a very strange situation. I think we mentioned it last week. This is the one where the CEO, John Kieran, who's the founder of System One as well, sold his entire stake to Brave Bison, that we know well and we like, which has very much put System One in play, I think. I think he left or was forced out or whatever of System One. And they've now just announced strong new business performance and record H2 revenue. So what on earth is going on here? I mean, I'm not complaining because I've got a small holding in it myself, but very, very strange turn of events here. So I can't really figure out what's going on, but I'm going to hold on to my small stake in System One. Something's going to happen, isn't it? I think the most likely outturn here is Brave Bison probably just bids for the whole thing. They've got Lord Ashcroft in the back room prepared to write checks for however much they need at Brave Bison, basically. Very entrepreneurial people. And I think you were speculating last time that maybe they've lined up, what's his name, David Kieran, to maybe go back in and run it once it's part of Brave Bison. So I don't know, but it's certainly looking a lot healthier for System One shareholders than it was a week or two ago, isn't it?
Yeah, it just seems crazy, because I can remember you were on I think it was a call, weren't you, about 6 months ago? And you heard the CEO at that time, the old CEO, basically saying the advertising industry had just closed doors.
That was in August last year. Yeah, it was a public webinar, and he literally said the clients have all just slammed their checkbooks shut. And I think either Saatchi or I think it was Saatchi said something very similar at the time. So sorry, carry on, Paul.
Yeah, and so consequently, and then a quarter later they come out with better than expected numbers. I mean, and they're looking at they upgrade their 27 numbers. I mean, or 26 numbers. Just seems
it's 7 or 8 months later. But yeah, I take your point. It seems it all seems a bit odd. I think they've drastically cut their costs as well. That was the other thing. Right. I think they've recognized System One wasn't really doing what they'd said it was going to happen, and I think they've taken an axe to their cost base. But yeah, it's in play. It looks interesting. Very nice balance sheet as well, System One. Pots of cash, although I think that did reduce by a fair bit at the last announcement, but it's still very healthy. So something's going to happen there, I suspect, in the not too distant future. Probably a takeover bid by Brave Bison would be my guess, but I have no information. That's total speculation.
No, I would agree with you. Okay, in that same sector, we've got another one potentially in play. We've got M&C Saatchi. We've had basically their CEO being removed, and then you've got Vin Murray, who's basically the sort of queen of tech, now as a non-exec director of the business, presumably to help release value. And obviously you did get Brave Bison putting a slide rule over their performance business, offering 50 million quid for it. What's going on here? This seems as though something is about to happen. There's too many big hitters around this sort of like advertising business. Yeah,
I think you're right. I mean, ADVT, that's Vin Maria's vehicle, obviously. said that it had no intention to bid for Saatchi's, and that was on the 9th of March. So what's that, 9 days ago? But she has obviously done some sort of deal to tighten her grip on Saatchi, if you like. So she's joined the board of Saatchi, Vin Maria, this is, as a NED, and she owns nearly 12% personally of Saatchi, plus ADVT owns nearly 10% of Saatchi. So the links between the groups seem to be tightening, but it's not going to be taken over by ADVT now. A 4.5 million buyback announced by Saatchi's. I don't think it really has the balance sheet to, well, it does just about, I suppose. It has got net cash. There's a few complicating items on it. But yeah, I mean, look, Saatchi's, we think is good value. It's on after recent falls, it's only on a PE of about 8. And I think it's a better business than people. It's not as cyclical as people seem to realize, and it does have some quite interesting divisions within it. That the general view I'm picking up seems to be that Saatchi's kind of needs a good sort out, and it looks like that is starting to happen now. So if you put a gun to my head, would I be bullish or bearish on Saatchi? I think I'd be bullish, actually.
Yeah, I'm with you. I mean, I don't think Vin Murray is going on that board just to sit around and do nothing. And yes. I think the other investors on board, people like Richard Staveley, are itching to get some value release on this one. And let's be clear about it. You and I spoke to Ollie and Theo Green of Brave Bison, and they were pretty much interested in that performance business. There must be an unbundling opportunity here, I think. Because it's a good name, isn't it, M&C Saatchi? And also their issues business, which is their sort of jewel in the crown that has been temporarily hit by that the US government shutdowns last year. Well, that's not happening anymore. So I think that's I think it looks to me as there's certainly more value than the current shares are reflecting, in my view. And with the people now in place, I think that'll be the catalyst to release some of it.
I think you're right. That's spot on to me. I mean, it's educated guesswork, as with all shares, isn't it, really? But I think you're right. When you get a lot of smart people congregating around a particular share, trying to make things happen, and the valuation is kind of at a low point, and you've got cyclical upside in there as well. Yeah, it all fits together, saying probably something's going to happen here, doesn't it? And I think risk reward on Saatchi's, I think looks quite good. Yeah.
Good. Okay, well, let's go to consumer review site Trustpilot. This shares have been bonkers over the past six months. It got attacked about 3 or 4 months ago by the Grizzly Research, saying it was basically an extortion racket, and the management vehemently denied it and basically just said, "Look, this is crazy." And the shares have absolutely rocketed since. What's your take?
I know, it just shows, doesn't it? Ultimately, fundamentals always win out, and they put out cracking figures yesterday. Trustpilot did, and we like it. I mean, we're only amber on it because the valuation's so high, but sometimes you've got to pay up. The PBT was up 172%, and that is for calendar 2025 from a low base, admittedly, which puts it on a very high PE. You're looking at something like 55 times. But when you blend in the outlook, where they're saying they're expecting high teens revenue growth in 2026 and a 2 to 3%, as in points, 200-300 bips increase in the adjusted EBITDA margin. It's very easy to do that on the back of an envelope and see that the profits here, if they hit those targets, could really soar, which justifies a high growth company PE. So yeah, I mean, I don't have a strong view either way on it, but it's certainly and maybe part of that 33%, 32% share price rise yesterday, maybe that was the last cinders of the bears being burnt at the stake here. In a way, sometimes going heavily bull on a bull stance, on a share that's being really heavily shorted, you can profit from these guys who are trying to scare everybody out of the share. You can profit on them, the whole thing blowing up in their faces, can't you? Which is it must be strangely satisfying, I think, for the bulls to see the bears get walloped. So no, interesting. It's got net cash on the balance sheet as well, Trustpilot. I still can't quite fathom if that business model is watertight, shall we say, or not. So no strong view either way from me, but another fascinating situation to follow.
Yeah. No, I mean, I would just add, in terms of, it can either be, the bull case is that it's going to be a winner in the agentic AI world because it's got supposedly independent, sort of consumer reviews that the likes of Gemini 3 and ChatGPT are going to use and cite as their evidence to go for purchasing for products, and therefore it gets a lot of free traffic and then helps their advertisers. That's the bull case. The downside is that they're very heavy. They will be heavily dependent on what ChatGPT and Gemini 3 cite, and so if they change their algorithms or go to somewhere else to do it, or actually question the authenticity, so it is actually quite volatile if those big sort of like agentic AI or large language models decide to change who they use for citations. But that's all I would say.
Yeah.
Okay, let's move to another shorter that may have a lot of BS as well. We don't know. Let's go to Close Brothers. These guys are effectively
gosh,
I know, yeah. Yes. I think they're a subprime lender stroke bank or something, but they've got a big problem. Well, not problem. They've had this exposure to the motor finance mis-selling scandal that they've reserved some stuff. Anyway, they got attacked by some bears this week. Viceroy Research. Do you want to take us through? And the shares got hammered.
Yeah, I've only looked very briefly out of it, purely out of curiosity, really. I'm not going to take a position either way on it. But yeah, Close Brothers, as you know, massively sold off on the car finance problem, recovered spectacularly on the upside. I think it doubled or tripled in the recovery, and now it's halfway back down again. So I had a very quick look at the executive summary in the Viceroy research paper, and I think they've put out some quite good stuff before. I think they spotted that Wirecard was dodgy years ago. So yeah, I was having a look at their website. It does look a reasonably credible operation, because a lot of these shorting so-called research companies are just basically a bloke with a computer making out he's some sort of corporate entity. But anyway, so you've got to be a bit skeptical with shorting attacks, haven't you, generally, because they've got a very clear agenda. They want to smash up the share price in a few days and then bank their profits and walk away. So, but basically Viceroy is saying that they haven't provided anywhere near enough, Close Brothers hasn't, on its balance sheet for the cost of the mis-selling thing. And they're basically saying if the way they've modeled the numbers, they think equity could even be worthless. Now, that seems to me, I'm not an expert on the share, but I had a quick look at the balance sheet last night, and I mean, it's very strong. It's very, very strong indeed. So I think it looks like an exaggeration to me, is my initial response over it. And these sorts of liabilities, they just date over a number of years, don't they? It's not like they're going to have to pay 600 million in one lump sum. It's like the phone hacking scandal for the newspapers. They survived it because it's spread over 10 or 15 years. So I don't know, it might be, I think this looks like an exaggeration, but they might well have a point. And they're flagging as well, tier 1 capital ratios and whatnot could be under pressure at Close Brothers. So it just maybe will galvanize investors into looking a bit deeper into the numbers before you can decide whether or not to sell or to just dismiss Viceroy as evil short-selling money grabbers.
Yeah, I mean, I think you raise a brilliant point that if they've had a good reputation in the past with Wirecard, they've got a bit of expertise, and that's what, hence the influence.
Could be.
But for me and you, I mean, frankly, and for most investors, we've got no insight into their lending book and their motive, and therefore it's basically there's much better opportunities elsewhere to decide to take a position. For me,
really good point.
I would never buy these on this potential problem simply, because I just don't know. It'd just be a total speculative punt, really.
Yeah, I agree. Without doing that really deep, granular research, I don't think you can form a view on it. So I totally agree. Totally agree, Paul.
Okay, good. Let's go to, say in the financial sector, let's go to interdealer broker TP ICAP. These guys do over-the-counter derivatives for effectively for hedge funds and for banks. Anybody who wants to be a big prime trader in things like oil futures, in interest rate derivatives, gold, silver, even equities, etc. They came out with some pretty good numbers this week. I don't know if you had a look at it. They're not expensive either, the shares.
No, we like it. We're amber green, which is 4 out of 5 star. This was 12th of March, so last week, wasn't it? Rose 11% on the day on its 2025 figures. Also announced quite a substantial buyback. Well, it's about 4% of the market cap, better than nothing. And you're getting a 6%, over 6% dividend yield as well. So put those two together, and that's what, just over 10% shareholder returns. It beat consensus earnings by about 6%. So that's pretty good. Balance sheet's good. It's got a lot of net cash, but bear in mind a lot of that is timing differences. So do be careful on the net cash figure. I wouldn't add that, enterprise value will give you a false number there. So good results, good value, lovely shareholder returns. PE is about 7.5. Net cash balance sheet. Yeah, we like it. We think it's really good.
Yeah. No, I think one thing that's sort of held the shares back of late or the last year has been they've got this division called Parameter that basically sells OTC derivative sort of like securities information, a bit like Reuters do, but to do it to all of these sort of like the prime brokers, and they're trying to basically separately list that in America. Now the only one, and the reason why they've delayed it is because of being the volatility in all the markets we've had, which is been a bit of a Trump victim to a certain extent. However, one thing I didn't quite like about the results, I mean, I love the business, no doubt about it, and it's very, very cheap, was the actual organic growth rate of Parameter has decreased from sort of like high single digits, low double digits to 5% organic. And that says to me, it hasn't quite, sort of like delivered, because they were hoping to IPO it on the back of this is a low double digit organic SaaS type business, software, high data. That may take some of the juice out of an IPO, because they were talking of about £1 million it was going to be worth, which is pretty significant given the market.
No,
sorry, a billion. Yeah, no, sorry, a billion. Well picked up, which is half their market cap. So it was supposedly a pretty big, a big IPO it's going to do. But hey, that'd be the only one thing I would just have a look at to see what valuation as a sum of the parts you would put on Parameter.
Yeah, no, that's a good point. I'd forgotten about that. That's been dragging on for a long time, hasn't it? That potential deal with Parameter. But I mean, overall, as a nice situation to just park some money and get a 7% odd dividend yield, it's got to be worth a look, hasn't it?
Yeah, good. Okay, let's stay in the finance. Last one on the financial. We've got Drew is asking about Funding Circle. Did they come out the results a couple of weeks ago? Basically. John, we spoke, didn't we? We spoke to Lisa and Tony earlier this week about their performance.
You start on this one, Paul, then I can read my notes on the other screen while you're explaining it.
Yeah, I mean, basically, just for everybody's understanding, this has got sort of like a number of parts. Its main prime value is that it acts as a conduit to place institutional money with small SME companies in the UK. And then separately, a smaller part of the business, which is faster growing, is their FlexiPay business, which essentially gives short-term credit effectively to the same companies and charge a higher rate. But that's actually on their balance sheet. Anyway, the key question that we had was going to be how resilient is the business, in a downturn if we start, and overall for a sort of like a lender, it doesn't all its balance sheet, but it's placing institutional money, so it's effectively like exposure is lending to small companies, i.e. subprimes, 10 people, etc., £70,000 loans. Its overall resilience is pretty good actually, because it doesn't take the credit risk, and it believes it's got quite sticky capital from those institutions. So that was pretty good. And then, in terms of their go forward, they're pretty bullish in terms of their guidance about, I think it's sort of like tripling their PBT and doubling their sales, 60% increase in the sales over the next 4 years. And that's made up from really strong growth, largely from their FlexiPay. But it is based on there being no recession in the business. So I would say it's an aspirational target, but frankly, they're not expensive now. So what was your take?
Yeah, very similar. I do like, I mean, this is the second time you and I have spoken to management there, and each time I feel I'm learning more about it. I mean, it's transformed from where they were a few years ago, where it was just a horribly cash burning sort of speculative thing. It's been totally sorted out, and it's an established, profitable business now. I do agree with you. I think given macro uncertainty, they've been much too aggressive on the forecasts that are out in the market. But I particularly like the fact that this is a sort of alternative, should we call it, to be polite, rather than subprime, but an alternative lender that I think the way it's all structured, where it doesn't take the credit risk and it doesn't, the lenders can't just pull their funding so that the whole thing collapses, which is the main risk in this sector. I take your point that yes, the lenders can pull new lines of credit. So the worst that can happen to Funding Circle, I believe, is that it could have shudder to a halt in terms of new business, you know, in a recession. But I don't think it'll be facing any sort of existential crisis like we saw in 2008 that caused a lot of these subprime lenders to go bust. So I do like it, I have to say. Not entirely sure how to value it. And I think we're getting ripples, aren't we, from the private credit market. I just personally feel this is probably not the right time to generally be initiating a new long position in an alternative lender. You know, but I think I'm building my knowledge on the company each time we talk to management. And I think at some point, maybe I would personally push the button and take a stake in it, but not right at the moment for me.
Yeah, you raise a very good point in terms of the whole worries about private credit and whether that would actually infiltrate sort of or triggered some lenders, some other institutional capital to actually withdraw that. They can't withdraw it overnight, but over time withdraw it, etc. So, because it isn't permanent capital, it's not like private equity. You put money down for 5 or 10 years. This is over sort of like 1 to 3 years. I think their average probably institutional money length is about 18 months to 2 years on that loan. But having said that, that's the risk. But having said that, I actually did a sum of the parts on it, which was because obviously we were always struggling out to actually value it, and I came to 480 million was for the term loan business. And that was a 12 times EBITDA. And then you add on flexi pay, and then you add on a bit of cash, and also they've got some carried forward tax losses. You put all that together, you get to around about just over £2 per share. So I think that, and that's not an aggressive valuation on some of the parts. Okay. And if they get anywhere near their estimates in the next 4 years, etc., which I actually don't think are in the consensus forecast. I don't think the brokers have put that in. I think that's what they would like to do. It's not with the brokers. Then the shares would probably double actually if they got anywhere near it. So it's an interesting one, no doubt about it.
It is an interesting business model, and it's not just a conventional savings and loans business. I mean, if you want things like that, you can go to OSB, which I think is a very nice, straightforward savings and loans business. None of those nasties on its balance sheet like the big banks have. So if I wanted something completely clean, I'd go to OSB. This, I think it is fair to say it's more of a platform business. It's an intermediary that is mainly, arranging loans and seems to be good at it from what we can make out. You did some scuttlebutt, didn't you, from your friend in the sector, I believe?
It's a good point. I totally forgot about that. Yeah, I did actually have dinner. It was an old school friend who actually arranges these loans, anything between sort of like £5 million to a corporate to 50 million. Okay, he's got his own business, got 12 people who work for him. Anyway, I asked him about Funding Circle. He said, "Yeah, really good business model." So. For somebody in the inside industry, he couldn't, and a competitor almost. He was pretty glowing about it. So hey,
that is encouraging. I mean, you grilled them quite hard on their lending criteria, and I do remember I think it was the CEO saying that look, in 2022, when the Ukraine war started and inflation started to go bananas, they did tighten their lending criteria. So they said they know what to do in times of crisis, but this time round they haven't seen anything in their data to indicate that they need to be tightening. But I got the impression from that they're on the ball. They said, look, we've been around 15 years. We've been through numerous serious crises. And that is an interesting point as well. It's not as if they're going to get hit by something like 2008 without having actually dealt with it before and knowing, well, maybe that was slightly before, but do you know what I mean? They know what to do in a crisis. All businesses do, because we've been in perpetual crisis for the last 6 years, haven't we, at least?
Yeah, I think you're being polite about my sort of like aggressive questioning, because I think they were tempted to say on your bike, Paul. All of my questioning.
No, you direct and you ask tough questions. It's brilliant.
Well, anyway, right, okay, let's move to the house builders. We've got Varun Kapoor. Which I think is one of your subscriber asking about Vistry. Is this a value trap or is this a value play? The shares have just been absolutely smashed in the last month.
Well, on the numbers, it looks dirt cheap, no doubt about that. And I think the balance sheet's absolutely fine. But you sent me an article, I haven't read it yet, I must admit, Paul, about the Times saying they're not paying their suppliers and whatever. So, and you did have accounting scandals back in 2024, 3 profit warnings. The numbers had turned out to be fiddled in one of their divisions. So it's got form, I'm afraid, to be blunt, for things not being quite right on the accounting side. But the balance sheet, as long as they, you know, maybe even if they're forced into asset disposals, they got so much in the land bank that they could, I feel the balance sheet is so strong that I think it's probably all right. But over to you, because you're a bit more bearish on it. So tell us your view, Paul.
Yeah, once you get, I mean, my only concern is that once you get headlines in the press in terms of the credit worthiness of a big company, whether it's Carillion and people like that, then if any of the credit insurers, the trade credit insurers, decide to sort of like get cold feet and not offer their suppliers sort of like, you know, 100% cover to Vistry, then you get that whole working capital unwind, you get a liquidity event. So I personally don't know whether it's a value trap or a value play. All I would say is that I wouldn't back it at the moment. I don't like headlines like that, because I've seen too many construction property companies, and particularly when you get MPs on the other side of the aisle, they're going to make a bit of a song and dance about this. So I think there's quite a lot of defense that the Vistry are going to have to do over the next few months to prove to the government that actually they are solid. And if they're having to do that, then there's going to be some quite hard conversations. I just don't. Anyway, it looks unbelievably cheap, and it does look like if I had no problems over what's been happening with the headlines, I would say, yeah, I'd buy it, I'd load the truck up, but I am not 100%. Got to remember, they did pay this huge special dividend out with the CEO about 18 months ago when they moved to this business of doing 60% of their sales being affordable. Because they get working capital benefit of it. They paid about, I think it was about, if I remember, 500 or a billion. It was a big number. Gosh. They paid out. And it might just now leave them a bit short in terms of their capital base. Not that I don't think if they needed to do a placing they could do, but that's saying to me, if the trade credit disappears, they're going to have to do a placing to fill that short-term liquidity gap. And to me, that's what the share price is saying to me.
Yeah, I mean, I've never seen a company go bust with a balance sheet that is this strong. That's all I would say. You know, your Carillions and all those facilities management things that went, a whole load of them went bust, didn't they? They all had diabolical negative balance sheets. This one is extraordinary. It's got so much land stuff. You know, they could basically just say, okay, we'll just auction off 300 million pounds of land, and that would be about 10% of the land bank. Do you know what I mean? So they might take, I think they could raise liquidity dead easy if they needed to, but they might then take a P&L hit from having to sell some land at a loss or something like that. I think the disaster scenario would be if these numbers are just pure fiction, you know, and that is a worry if they're not paying suppliers, because as you say, that is often the canary in the mine, isn't it? Businesses with supposedly strong finances that can't pay the bills, something's badly wrong. So I think it definitely needs carefully looking into, for sure.
Yeah. Good. Okay, let's move sectors. Let's go to industrials. We've got Stephen Cahill asking about Victrex, which I own. These guys do peak polymer for sort of parts and stuff for numerous different industries, for oil and gas, energy, for medicine or medical parts, etc., for a whole bunch of different industrial applications. Don't you have any thoughts? I mean, the shares have been battered of late.
I haven't looked at this since the 6th of February when it put out a Q1 trading update, so I'm not really up to date on this. Have you got any thoughts, Paul? And I'll just quickly look at the numbers while you talk.
Yeah, basically I would say, Stephen, the big Achilles heel on this one has been medical for the last 3 years. It's been losing market share to, I think it's titanium cage devices that go into people's spines in the medical side, which is really high margin. And they've got some new products coming out made with PEAK, which is, it's a better performance material, but they're playing catch up in that. They took basically the management team took the eye off the ball over the last 5 years and allowed titanium to get into that spine, which is a big profiter. Outside of that, in medicine, their other products are doing pretty well. And they do also have this really sort of big opportunity in PEAK knee, which is being going through the regulators in India. And if they can get in with India, they'll get hopefully get the EU, and then eventually the FDA approval over the next few years, which could be revolutionize knee operations, which is great. So they do have some upside, and likewise they've got this sort of big opportunity with, I think it's Technip in doing these big, large oil and gas tubes or pipelines out in Brazil. I think it's with Petrobras, that has been going through sort of like conformance testing at the moment. And if that gets signed off by the end of the year, that will be a huge opportunity, because it could potentially change steel pipes to effectively this composite using a much lighter and more durable PEEK polymer, which would be big volume. Now, those are two really big opportunities. However, I would say, yeah, they're not slam dunks. There's still uncertainty associated with it. And the market is clearly saying, you know, the GDP, industrial production losing its core, you know, spine, profitable spine business, and therefore we're selling. We're not going to price in any potential upside. I'm personally, as a shareholder, this is in the last saloon to me, last chance saloon. And I'm going to wait for the next year to see the outcome of what happens with the regulator with PEEK knee, because that will be massive if they do it, and also with this Petrobras testing out in the oil and gas industry, and that could really change the business. But it is high margin, it's profitable, but effectively it's been living off, in my view, it's been living off its good products and its market position for too long and not being innovative enough. Now it's had a new CEO coming in just recently, who I think is going to put a slide rule over a lot of their innovation spend, and it might well cut down some of their products to concentrate on the really good ones. And then the other thing, which has actually been knocking it, unfortunately, has got this big factory out in China, and it's even though they built it, it's still unprofitable. I mean, it's, you know, they basically should just be lifting and shifting technology they have in America, in Europe, in the UK, the blueprint of that factory out in China, but they can't get it to work. And so they've got a big business in China, but they're still having to import those parts from the UK and from America and Europe to service their clients. They should be using their existing facility. So to be perfectly honest, they haven't. The management team, deservedly, the CEO, I think, has fallen on his sword, because they haven't really done very well.
Yeah, and that's what the long-term chart is telling us as well, isn't it, on Victrex?
Yeah.
I would say, while you've been talking, I've been taking it all in and looking at the numbers as well. I would point out it's got an unusually good balance sheet, actually. There's hardly any debt, so no worries there about dilution, which is a big positive. And also the dividend yield is knocking on the door of 10%, but it's not covered by earnings. So I would work on the assumption that the dividends could be, say, halved. I think because the balance sheet's strong and there's hardly any debt, they'll probably keep paying some divvies, but I wouldn't hang your hat on the 10% dividend yield. I think this looks the type of thing that could easily stage a nice turnaround on some good news. So I think if it's, I can't see any catalyst to want to buy them fresh, but if I held them personally, I think it's on those numbers, I'd probably sit tight. And
I mean, you could always get a takeover bid as well from private equity.
Or an unbundling type of thing. They're quite popular at the moment. Have Harwood bought in? Do you know?
No, I don't think that. I don't know. I don't know, but I don't think they have. It's
okay.
It's been a bit of a dog, and I think there's plenty of other better opportunities. I'm just basically, I'm a disappointed shareholder. I'm over 50% down on it, which is like, that's the way it goes. You know, this is what happens in these things. And you just got to say, well, actually, I'm going to give it the last chance, see what happens with these two really good sort of like dial movers for the business, value creators, these triggers, and that will be in 12 months. So I'm happy to hold and see what happens there and pick up the dividend.
I think that's a perfectly rational decision. It's not like you've fallen in love with the stock or that you're too stubborn to sell. You know, the numbers are saying, actually, this is probably risk reward might actually turn out to be all right on it. You don't have to worry about dilution or solvency. I think that's a rational hold, actually, Paul. Yeah.
Good. Okay, right, let's move to software. We've got one which has come down a long, long way. Intercede. These guys are probably a world beater in all things credential management and ID, selling most of their software out actually into the Department of Defense, or Department of War, I think Trump calls it now, out in the States, and their suppliers, people like Boeing and stuff. The shares have absolutely been hammered. They're down to 77p at the moment, down from a top of round about nearly £2 or 190 anyway. What's your latest on Intercede?
Obviously, very, very disappointing. I have a small position in this myself. I'm very much glass half full on this. I appreciate people are emotionally battered by this, but the net profit warning yesterday, we published a section on it on my Substack today. I asked one of my colleagues, Dave, to write or John to write it up, because I'm probably too biased, because I've followed this and invested in this share for many years. It's been a terrific turnaround, but then, as you say, it's dropped by about 2/3 from the peak, some of which is justified, but a lot of which isn't. I think this is massively overshot, not massively, but considerably overshot on the downside now. They said yesterday that the net cash figure is around £20 million. So that is knocking on the door of half of the 46 million market cap. So you're getting a profitable, deeply embedded, highly specialized world leader, really, in credential management for enterprise software, with a client list to absolutely die for. I'm very much glass half full on this at 78p. If it was still around 150, £1.60, I'd say, okay, up with events. And you've had the general AI panic, which I don't think even vaguely affects this. This is such a crucial, mission critical software. I don't think that AI has any threat to it whatsoever. So, you're not going to be using a chatbot to authenticate whether you can get access to the Pentagon's computer system, are you? It's ridiculous. So yeah, I think this is a buying opportunity, but it looks to me as if we're at a sort of capitulation sell-off, because the shares had already halved on worries about the US government shutdown, all the various other things. But then it dropped another 20% yesterday on actual news that they'd modestly, not huge amounts, modestly missed the March 26 forecast. Still nicely profitable, very, very solid cash flow, terrific management. I think this is an unequivocal buying opportunity, but I could be wrong, and I don't know what the low price will be. So what I tend to do in situations where they're just in free fall, but the fundamentals are actually fine, I just stage my buys. I'll break it up into 3 or 4, and basically the further it keeps falling, the more I buy. So what's your thoughts, Paul?
Yeah, no, it's very interesting at the moment. One question I would have, though, if it's so entrenched and mission critical, why do they get delays to orders? Because you'd have thought they'd have to actually buy it.
I think it's more that they're embedded, and then once they've, it's the growth. They're struggling to get the additional growth. I think that's the point. And it is, a lot of it is big license wins, one-off wins. But they tend to, once they're in somewhere in one of these federal organizations or Boeing or, Airbus, they're in an amazing big, once they're in there, they'll be in there for 15, 20 plus years. Do you see what I mean? So they get but a lot of the license revenue is kind of 5-year renewals and that sort of thing. They are struggling to get decent top line growth for sure. But they did reiterate, actually, the March 27 targets. So they said these are genuine delays in contract signings. They've not lost the business, and I trust the management here. They're very good. I've followed them for 5-6 years. They've done a remarkable turnaround here. So yeah, for me, this is definitely glass half full, but I appreciate, it's a market. People will have different opinions, won't they?
So what you're saying is that the delays have been these perpetual license sales. They haven't been delays.
I don't know the exact details of it, Paul, but yeah, a lot of the contracts are kind of incremental sales to US governments, and obviously the shutdowns are bound to have had some effect on that. I think, I suppose a bear might say, well, hang on, a lot of these are per user type contracts, and will AI mean that the number of federal employees will drop? Well, if you believe that, I believe anything. What's the public sector are not going to make themselves unemployed, are they?
Yeah,
that's one thing they're really good at, keeping their own jobs.
Yeah, I think the big risk is that they're a small UK company which is punching massively above their weight in the US DoD and the US DoD suppliers. Now, if you were Trump or the Minister of War, etc., and you saw that there is a risk, slight, very small, that they say, actually, because it's so critical, I want the likes of big US-owned software, cybersecurity, the likes of CrowdStrike, Okta, I don't know, maybe Palo Alto, people like that who have huge credential, sort of software. we want actually on this side of the Atlantic rather than coming out from the UK.
I take your point, Paul, but it's such
Yeah.
a small part of big
Yeah.
enterprise systems. That's the thing. They probably wouldn't even know that the credential management is subcontracted out to. Do you know what I mean? It's a tiny part of big computer systems. So I take your point, though, that we should probably ask management about that. Yeah.
But I'm with you. I think if I'm looking at it, I think on the there's always risks about everything, isn't there? But on the balance of probability, it's one to definitely have a good look at. In fact, I will have another look at it because it's a class operation with brilliant customers and it's very cheap at the moment. Okay, another one which has definitely been hammered is we've got Andy asking about Beeks Financial Cloud. These guys do the hardware and the software that enables exchanges and traders to perform high frequency trading of any type of security, whether it's sort of like on exchange or in fact it would be maybe also OTC, but probably just always on exchange. But anyway, what's your thought? The shares came down after I think half year results.
This is pretty much exactly the same. It disappointed short term. The H1 numbers actually showed a smallish drop in revenue and profitability, which the market should have known about because they put out the revenue miss, a drop of 7% or something. They announced that in late February. But I think in very, very jittery markets like we've got at the moment, people are panicking and selling first, then going back to revise the numbers. So this, again, to me, absolutely unequivocally, it's a buying opportunity. For me personally, obviously people need to do their own thing. I've just come off a webinar, a public webinar that was between 1 and 2 o'clock today. So and management have fully explained why the short-term numbers disappoint. It's essentially contract timing and shift to like a SaaS model from a one-off licensing revenue. Put the two together and they've got a really strong H2 pipeline for deals that were signed in Q2, but have an 8 to 10 week implementation period, which means the revenue recognition dropped into H2. So they've explained it all, and basically they're in line with full year expectations. I won't go into all the details on the business model, but for me, very definitely one of the UK's best compound growth companies. You don't value it on current earnings, which are actually on statutory numbers, actually small losses. You look at where the very strong recurring revenue growth, and management are super confident medium and long term. This is just dominating its niche. It's going to be a much bigger business in the longer term, I think. So yeah, probably at the current price, I think that sell-off is overdone. I think it's a very, very good, strong buying opportunity for me personally. May not be for everyone.
Yeah, just in terms of their margins, I mean, for a high-tech sort of software, hardware type business, it makes 40% gross margins, which looks as though their operation. I mean, that's not bad for if it was a manufacturing business or a distributor, but 40% margins doesn't seem to chime with sort of the.
No, it's not. It's not a software business, though, or part of it is, but the core business is just providing cloud infrastructure for the exchanges and for individual clients. But there's a cost of sales to that. So yes, I think that side of the business, I believe, is about 50% margin. So yeah, not really comparable to a software company, but they are developing AI tools, and they're on the cusp of signing a big contract for that, which is much higher gross margin. And also because you had in the prior year numbers, you had much higher initial, when contracts went live, they recognise half the revenue up front. They're now doing revenue share model where that doesn't happen. So that has knocked the margins down in the short term. But what they explained in the webinar is that they've then got a 10 or 15 year annuity stream basically from these contracts. They land and expand as well, which again they can demonstrate from, for example, the Johannesburg exchange, which has been a huge success. They've got Canada, which is the 6th biggest stock exchange in the world, about to go live next month, which will start kicking in revenues. So I think a stock market sentiment on this stock, I think could turn on a dime from glass half empty at the moment to glass half full. But yeah, very interesting stock, I think.
Okay, good. We've got to stay in the software sector. We've got Grant. He's asking about Fonix, which basically is I think it's probably the UK's sort of largest, certainly most well-known sort of SMS sort of payments type business. It uses, as a typical example, you have a big charity on telly who's got a big campaign like, I don't know, sort of child night or something like that, and then people donate money, and then it does all of the effectively that campaigns, etc. Shares have been badly hit of late, even though the business fundamentally seems to be getting better because it's expanding abroad.
Exactly. A nice summary, Paul. This again went on my buy the dips watch list that I published over the weekend. I thought, well, what's the use of having a shares commentator who doesn't flag up bargains when the market throws a wobbler? So I did a video on my Substack over the weekend flagging up a variety of sort of compartments of where I'm seeing buying opportunities, and Fonix is one of them. Fundamentally sound business. Recent update was fine, is good, high margin business. It's derated from a PE of the mid-20s down to about 13. It generates loads of cash, pays it out in divvies. I think it's a lovely business. And as you say, it's, dividend yield nearly 6%. Market leader in its space. It dominates UK and Ireland, but it's also successfully expanded into Portugal. And they're now, I think, trialing a fourth European market. They just seem to be really good at what they do. And everyone says, oh, it's old hat. You know, young people are not interested. I don't know any young people who vote on TV Voter. Well, sod the young people. They haven't got any money anyway. You've got tens of millions of middle-aged and older people like us who will happily vote 10 times for Kerry Katona or whoever to be kept in the jungle. You know, and the figures from Fonix show that this is a great business with a moat, because the clients, you know, it never goes wrong basically, and the clients make a ton of profit from these phone-ins, so they keep them going. And you don't have to have 18 million people watching I'm a Celebrity. You know, basically it's so profitable that even a relatively small TV audience can generate a ton of profit for the TV company, which is why they do them. And Fonix never goes wrong, so they hardly ever lose a client. So I think it's a lovely business. Definitely the market is offering you a mid-season sale bargain, in my opinion. I don't hold it personally. That's just my independent view.
Yeah, I think you're right, and it has a bigger competitive moat than would be initially thought. Simply because if you're a big charity, you're not going to give it to a company that hasn't done this before, and there aren't that many if it's rivals around. The only slight, I suppose, it's a sense of ambition. I don't know whether they've got a new CEO now, but it's taken a long time to replicate that UK model and go abroad. I would have thought they should have done that 10 years ago.
Yes, fair point. I haven't got the answer to that, but that is a fair point. I mean, I had an initial chat with management when this floated, and I remember thinking, God, these guys know what they're doing. Big owner-manager stakes. You know, they've run it really, really well. IPOs, normally something goes wrong, doesn't it, after about a year or two? But this one hasn't put a foot wrong, but it's just derated because I think the market perception is, oh, it's not really a growth business, but actually it is. And you see, they've got that window of opportunity. The software has to be able to take millions of calls in about 10 or 20 minutes. You know, if it falls over, bang, that's it. The whole thing's ruined, and the broadcaster doesn't make the money, and so it's that essential reliability where you're right. You wouldn't use any other company, would you, if you were the TV company? Because if you switch to save, 0.1% and it fell over,
exactly.
So I think they've got a good moat, I think.
Yeah, so do I. Yeah. Okay, good. We've got Gordon Stewart. He's asking about educational edtech software company Tribal, which I own, etc. Again, the shares, like almost software companies, have been battered of late, even though it's actually had a couple of recent upgrades. I think it's got its results out actually next week. So, any quick thoughts on it? I own it, so I've got plenty, but.
Yeah, I do quite like it. I'm not quite as keen as you on it. No, actually, look at my notes here. We upped it from amber to amber green last August. So yeah, the news flow, we've looked at it 3 times and the news flow has been good. Slightly ahead of expectations on the 29th of January, so that's good. I think they've straightened out the balance sheet, haven't they? And they've now got net cash, so that looks all right. I think it's quite good. So do you want to go in a bit more detail, Paul, because you know it better than me?
Yeah, I mean, I bought a full position some time ago, and I actually topped up just recently on the downturn. So I'm pretty much loaded. So I am biased on this one, okay? But I mean, I do the sum of the parts on it, and I can't get less than £1.50 to £1.20 on it. And the reason is you do 3 times our ARR of their software business that goes into universities, and then they've got this ed tech services business, which I think they're going to sell towards the back end of this year or early next year, which will get them about 15 million. And now they've got net cash of 11. But some of it was working capital go forward, but they've got a net of about 8. You put all that together, you get over £1.20, and it's recurring high value, revenue streams in universities. And the thing the reason why I increased my position, which was a bit ballsy for me. I don't normally do that, okay? But I did it simply because the last trading update, and they've been pretty cautious about what they've said in the past. They actually said the downturn or the difficulties of the cost-cutting measures in the university sector is actually stimulating people to move on to their SaaS. And I thought, wow, you haven't said that before. You've said it's a headwind, and now you're saying it's actually a tailwind. And once they get more and more onto this sort of like one-to-many type SaaS model, rather than sort of the old bespoke where they're running, they can take their costs out. And then you've got this captured sort of like customer base. You can just do AI, and it's basically entrenched software that you just add on new software packages. I think I can really see these guys helping the university sector reduce their headcount and labor if they want to, and then just expand with more software. So you're effectively replacing the labor content of their P&L with software that's a lot less. And I'm very, very positive on it. They've got the results out next week, but I mean, I could be totally wrong. But hey, I'm eating my own cooking on this because, I definitely have put more money into this, but hey, I've been wrong in the past. So
I mean, the only thing to push back on that slightly is it has got a checkered history of screwing things up quite routinely and repeatedly. But I think it's a much better business now than it was, say, 3, 4, 5 years ago. And 70% plus recurring revenues is a nice position to be in, isn't it? So it does look quite good, I must admit. I quite like.
Okay, good. We've got Rebecca asking about Spire Healthcare, and she mentions, which I do know, the put-up shut-up is at the end of this week. In fact, it's on Saturday. Between the private equity bidders, we've got Bridgepoint and Triton who have to submit their final offer. So we probably won't hear unless Sky breaks the news on Saturday or something, which they've done before. But we probably won't hear until next week. The shares, which you've said in the past, of definitely reflecting no deal's going to happen. I don't know if you got any quick latest thoughts. I mean, I've got a couple I could add on.
No, the last update I've got was 5th of March, full year results, which were not good. I mean, that was a mild profit warning, basically. But and they've got this problem with the NHS funding, haven't they, with time? But they're cutting costs and whatnot. But it's really about the property, which we've covered loads of times here before, haven't we? So the bidders are looking to basically buy it for the undisclosed freehold value, which I mean, as you say, the share price, it doesn't look like a bid is imminent, does it? So what do you think, Paul?
Yeah, all I would say is that if you've got the final date on Saturday and you've got and neither of the two bidders, which they would publicly have to do, have walked away, they're still interested. Okay.
Yeah, that's a good point.
It's if they were just said, like, okay, which you could understand, geopolitical, volatility, etc. But they would have walked away before this. These guys, so there's definitely still interest in it. I did actually interview Stuart Whittlesome of Odessian on Monday and asked him about healthcare. And he's at the Harwood, he's part Harwood stable, etc. And he thinks on the balance of probability, you will get something of a bid. Now, whether it's going to be an infrastructure deal or it's going to be a full takeover, we don't know. And I suspect it's going to be a full takeover because I don't believe Bridgepoint or Triton are interested in giving them cheap finance for their infrastructure, not only the company. They want the whole shebang. Why would they do that? Because they want the upside and the equity as much as they do. They're not just debt financing guys. These are private equity. They're not private credit. So if they're still interested in it and they haven't walked away, I don't know. I'd be more positive actually, but hey, as again, I'm biased. I've got shares, so I don't know, and we'll wait and see. But you're right. If you were looking straight at the share price, it says that ain't going to happen. But Stuart he said on the balance of probability, it'll probably happen at a lower clearing point than previously anticipated. But he didn't know. Yep.
I remember listening to one of your interviews with Stuart Winterson a year or two ago, and it was outstanding. So I'm going to download that and go for a walk in the sunshine here in Bournemouth after we've finished and listen to that. It should be interesting. What was I going to say? Oh, yeah, there was a really small boutique deal, legal services, I think, company. I can't remember the name of it, but it put out a profit warning this week where they said the Iran war has brought the deal flow to a complete standstill, which I thought was of, here we are, DSW Capital. Now, it's a tiny thing, only 11 million market cap, so I wouldn't have imagined they'd be involved in larger deals, but they basically said, yes, here we are, quote, the outbreak of war with Iran has severely impacted M&A activity in the UK, with many deals the group expected to complete in March being aborted or postponed. So what do you think about that, Paul?
I could understand it whereby you've got debt, because I don't think it's as, there is obviously a bit of volatility on the, there's the geopolitics and stuff like that. But it's the private credit boys. If you haven't actually got your funding sorted out, then clearly the cost of debt is going up. But with Spire, for instance, these guys are private equity guys. They will have already got their funding sorted out. Okay, so I don't know. I mean, it's about a 1.5 billion pound potential deal that they're going to do. I don't know. If that was going to be a problem, they'd have walked away already, because these private equity guys do that. I don't know. It just doesn't. Well, let's wait and see. It's total speculation. I could certainly see it whereby you've got deal flow. Would you? I mean, let's be clear about it. In the software sector, it got things like Pinewood got rejected simply because of the disturbance in the software side. Then anything which is going to get done by the Middle East, etc., or probably people will take the foot off the gas. And if interest rates or yields on gilts start continue to go up, then that will put a question mark over being able to raise money, particularly given the cracks in the private credit side of it. We'll just wait and see to a certain extent. But
we've got quite a few deals in progress as well. I'm just looking at my bids page on my my app, and you've got senior, haven't you, which is in having various people circling it. So it'll just be interesting to see how many of these actually go through and how many fall through. I can't see any fresh bids since the Iran war started, which was, I think, 28th of February. The only one I've seen is CAP Payments, which we've just discussed, StoneX. Apart from that, there haven't been any other fresh bid approaches. Well, you had Amadeo Air 4 Plus on the 6th of March, recommended acquisition, but apart from that, I've not seen any new bid approaches since the Iran war kicked off. So we might see a sort of pause on. So we'll keep our eyes peeled on this and see if any of the existing bids fall through. That'll be the other interesting thing, won't it?
Okay, well, let's go straight to one of those. Let's go to ITV, because it's got two parts of the business. It's got its terrestrial telly business that's actually under interest from Sky, or the owner is Comcast, I think it is. And the muted number, I think, from the press has been 1.6 billion or pounds or something like that. And then it's got this bigger part, which is the studios business. It's actually is roaring with all that content. How do you see this one?
Well, we last covered this on the 5th of March, so quite recently, a fortnight ago. Full year results for calendar 25 we thought were good, ahead of current market expectations. The only thing was on the outlook statement for 2026, ITV said it was confident, but lower margins, or at the lower end of the range, I think, and an H2 weighting. So I was a little bit put off by that, but actually the shares have held up surprisingly well, I think, as you can see on screen. Balance sheet debt is fine, and the pension deficit was all resolved, so that's all sorted out. I think it's quite good. I mean, it is on a low PE, perpetually in bid or merger talks, isn't it? ITV has been for years. It's fundamentally a good business, I think, if you dig into it. But again, I think it'll probably always be on a low PE, because people just say, not even going to bother looking at it. Terrestrial TV is dead. So you can't, it doesn't matter what the numbers are, where a significant chunk of the investing community won't even look at the numbers because of those preconceptions. I think the divvies are good here as well, aren't they? I haven't got the yield to hand. Yield of about 6% or thereabouts. So Yeah, I like it, but I don't. It just doesn't seem to go anywhere, as you can see from the share price chart.
Yeah, I would say there's definitely an unbundling opportunity. I mean, Sky has been sniffing around it for some time. They must be interested. Let's just, for argument's sake, they put a 1.5 billion pound bid on it. Okay, then the market cap currently is 3 billion, but they've got about half a billion of debt, so their enterprise value is 3.5 billion. Okay, so you take 1.5, you get to 2. Now that leaves them with a studios business. Okay, now if they were going to, potentially then could be a target. And the reason I say it could be a target for the studios business is that Netflix have just walked away from Warner Brothers and want a content studio business. Now, it just wouldn't be out of money. It wouldn't be out of all imagination that they think, right, okay, let's go for a cheaper nugget and target, the effectively iconic ITV studios. And so if that was the case, then basically, and the mooted price for the studios is about 3 billion. Okay, so effectively, if you get from an enterprise, well, basically, it'd be a market cap of 500 million. If you take the 1.5 off it, is that right? No, 1.5 billion, and you take off the debt and that, and then if you get basically if you get 3 billion in, then you take that up, you basically add the debt back. So you could easily see these shares, because of the debt gearing on it, going up by 50% just if they do an unbundling on it, Because you go from an enterprise value to 4.5 rather than 3.5 currently, but because of the debt doesn't move, it moves the share price up by probably about 50%.
Absolutely.
Yeah,
no, interesting points. I did hear somebody, I can't remember who, raise the issue of the fact that unbundling it might damage the business, because the studio side of things presumably benefits from the fact that the terrestrial TV stuff commissions stuff from them, which, if they're not part of the same business, maybe that would damage, maybe they'll commission less stuff from ITV studios. I don't know. I thought that was an interesting point to query. I don't have a view on it personally, but overall the numbers that I think at ITV look very attractive. So
good. With move sectors, we've got consumer goods or sporting goods. We've got Rick. He's asking about JD Sports, fashion, obviously the shoe manufacturer and all things sporty, retail-y sort of stuff. Any quick thoughts on it?
Yeah, I mean, it just always looks so cheap, doesn't it? The trading updates have generally been all right from it. Majority owned by Pentland, so it almost certainly won't be a bid target. You've now got forward P of just over 6 times. Balance sheet's fine. You don't get much in divvies. I don't know if they do buybacks. I think they've mainly reinvested cash flows into acquisitions. I mean, it's got a remarkable long-term track record. I think they peaked at about £2.34, and they're now down to about 70 pence. I mean, it just looks so cheap, this one. But it's looked cheap for quite a long time, hasn't it?
I think everything is, this, as you rightly say, there's so many bargains out there, depending on what sector you want to go to. And if you've got a long-term view, then I'd be surprised if you lose money on this at these sort of prices. Even though I don't like retailers, but frankly, you're right. It's just a giveaway, isn't it? So like the stock market is for people who are interested in long-term investing. It's just a giveaway.
Oh, it's extraordinary. I think, everyone, I just don't understand why it is that small caps investors in the UK are so jittery, so nervous. They just panic sell on anything going wrong geopolitically, despite the fact that you're already starting at cheap valuations. I mean, we're just I'm so excited about the current valuations in small caps. I'm looking at everything in my portfolio. Should I be selling it? Should I be trimming it? You think you'd be insane to sell at this price. These are great businesses, and selectively, 2/3 plus of the UK small caps market is junk, I would say, or poor quality anyway, not all junk. But you sieve it out, and the quality businesses, like a lot of the things we talked about today, are at fabulous valuations, where particularly if you can collect in a 5%, 6%, 7% dividend yield, well, you just wait for the market to regain its composure, which it does every time we have one of these frequent geopolitical things. Look at the tariff sell-off last year in April, then bang, V-shaped recovery, and we've got all our money back and more. So I think, you've got to keep a cool head, look at these situations and just say, it's, the absolute, the world going to hell in a handcart scenario never plays out. We always find a way of muddling through, and it's people with the determination to just screen out the background noise and think about the company fundamentals for good businesses, you're laughing when you buy at these sorts of valuations longer term, I think, in my opinion.
Yeah, and you just got to accept that it's impossible to buy at the bottom. And so if you do temporarily catch a falling knife, well, that's life. That's what happens. If you want to be in equities, you can easily see the following day, you've often bought it at a really low price. It goes down by another 10%, another 15%.
Oh, easily.
That's what happens. So, but if you're looking for the 100% upside in a year or 2 years time, then you've got to make a decision, because you've got to, as they always say, you've got to be in it to win it.
You have, and I think the main thing to avoid, which I think we mentioned strenuously last week as well, is anything that needs to raise cash. This is a terrible time for companies raising cash in a distressed situation. We had Videndum and Light Science Technology, which both effectively wiped out existing holders because they were desperate to raise cash. And, these things are hiding in plain sight. You can just look at the balance sheets or look at my Substack. We flagged them all up to people. The sort of thing, Midwich was one, and STV Group were ones this week where I'm ringing alarm bells and saying, look, these could have to raise cash. And if they do, your existing equity is going to be a lamb to the slaughter. So avoiding those situations right now where emergency equity raises could happen, Aston Martin, Lagonda, Victoria, Synthoma, there's lots of these things at the moment. I wouldn't touch any of them, not in current markets, because the merest whiff of a placing coming, there's only about 15 investors in the market to provide these companies with funds. I've heard from companies that I think we've spoken to. They said there's nobody interested. And so the guys that are prepared to stump up fresh money for distressed situations, just name the price.
Yeah, that's what happened with Light Sciences. I know the guys who anchored it, the family office, and I think they weren't a shareholder, but they are now at a very nice price. Okay,
well, exactly. Yeah.
You're very wise words there, Paul. Okay, I'll be remiss of me not to mention Intuitive Investments. These guys do basically, they own a big stake in some technology company out in China that is helping the Chinese lottery become digital. And I think they came out with a good trading update. It was quite interesting. The reason why I say it'd be remiss of me, because you've also got to be quite thick-skinned if you do mine and Paul's jobs, because I got absolutely slated this afternoon by putting some honest views by one of your subscribers, a Mr. I think it was Wizard of Windsor anyway. But
Windsor, yes.
I'm sure I'm wrong, and he's right. But anyway, what's your view on it for the benefit of old Mr. Windsor the Wizard?
I wouldn't touch it. I mean, it's one I haven't looked at for several years. It's basically dripping with red flags, the main one being China. Back in 2015, I warned my readers away from all of the Chinese AIM floats because none of the figures made sense. And basically, I think all bar one of them turned out to be frauds. And that was about 30 companies. So now I'm not. So that's why personally, I wouldn't touch anything on the UK markets that's linked heavily to China. Do you want to talk through some of the? I mean, there's other red flags here, but talk through the ones you mentioned.
The actual news flow is positive on the company, and I would like to say also, I interviewed John Shinnery, the Oak bloke, about 3 weeks ago, and he mentioned this stock as I think he owns it, and he's been recommending it. So he's positive. Okay, so there's definitely a bit of Marmite on this one. There's some very bright people,
yes,
John, who actually do like it. But
there's plenty of bright people who don't like it as well.
Yeah, well, there's that as well. But anyway, the reason why I haven't really looked at it, but I'll just say I'd be slightly cautious on it because I couldn't find their fine. Effectively, they own this company called Huey 10, okay, which is the tech company in China. And I can't find who their auditors are, and I certainly can't find their financial numbers. So how the company Intuitive have got comfortable with the valuation, I don't know. If there's no publicly available information, and then when you look at through all I would say is that just if you're going to invest in it, it could be potentially an absolute multi-bagger. Don't get me wrong, but just be really comfortable about the transparency and authenticity of those numbers to get that valuation. Because once you can't get a financial accounts of effectively your company that you own, I just think, wow, that's if there was ever going to be subterfuge in this one, that's the best way of doing it, because nobody's looking at your numbers. It's not publicized. There's no. I'm sure there is, but anyway, that'd be my only take from Mr. Wizard of Windsor. But
I think
he's probably right. He's probably right.
Yeah, I think what it is, the people who like shares like this tend to be, I don't want to use the word gullible. What I mean is believing. They tend to just look at RNSs, believe everything in it automatically is kosher. Whereas I think people like you and I who are just much more skeptical. We look at things and say, well, does this make sense? Is that, what about this? What about that? And you get a feel for things that just don't smell right. And that's the way I'm looking at this. But I'm heavily influenced in that by my experiences in 2015, where I was very nearly sacked when I worked for Stockopedia at the time. Well, they nearly sacked me dozens of times, but that's another story. But I nearly got sacked because readers said, stop Paul Scott writing negative articles on Globo. I wrote 29 articles over several years saying this thing is dripping with red flags. Yeah. It's not right. And I said to Stockopedia, well, back me or sack me. I'm not going to stop telling how I see the figures. So, and they did, to be fair, they did stick by me. And then sometime later, out came the announcement. It's all fraudulent. It was all made up. And you see, sometimes when you're good at sniffing out these things, you can just smell something isn't right. And what's the worst that can happen by you and I not buying this share? Yeah. We might miss out on a wonderful investment, but we're definitely not going to lose any money, are we? So I think people just look into the weeds, dig into this. I'm not saying there's necessarily anything wrong with it, but a lot of smart guys have said to me in my network have said to me, I wouldn't touch it.
Yeah, and it's quite interesting you mentioned that, because anecdotal evidence, when you and I talk about shares all the time, okay, and we always get criticized, so that's not a problem at all.
Oh yeah, that's fine, that's part of the course.
But one thing I do find quite interesting, where you get really vitriolic abuse, then that's actually a red flag in itself, because because very rarely do you get it, and I always stay well away from theirs, because they can be very, very vociferous. And but that doesn't put me off. It just these kind of companies just attract those type of investors. And so I don't like that, to be perfectly honest. Not because of the abuse, but actually it undermines the investment case to me, because they've got such an army of really, really people who are after it. And then there's a number of others it doesn't happen that often, but there's a couple of other stocks which have the same thing I talk about and get absolutely nailed by somebody, just because they don't like what I'm saying.
Yes, you're 100% right. I've seen that before as well, not just with Globo, with all the Chinese shares. I remember, I think Simon Thompson was done over by all the Chinese things, and he thought they were all wonderful. And he took a sort of side swipe at me publicly to say that I was sort of a destructive, malicious influence or something. But of course, they were all shown to be frauds. But he wasn't doing anything wrong. He just believed the numbers. It was unthinkable to him that these numbers could have been made up. And that is the thing. Having seen so many things go wrong, I think you and I are just rightly cynical about things.
No, we shouldn't be too cynical, should we? Okay, let's move. Let's go to industry. We've got Ray Stewart. He's asking about Zotefoams. He said great results yesterday. Still undervalued. Any quick thoughts on these guys? Basically, do specialist foams that go into athletic shoes or running shoes for Nike, but also for lots of really quite niche activities. And they're building this facility, I think, in Vietnam as well. But they did mention about, is it 3 months ago or something, that Nike's order flow, they had a bumper session last year. They might just sort of flatten off this year. But anyway, if you take us on from here.
Yeah, we like it. We've been multi-year bulls on this, on my Substack. We obviously got hit hard and heavily criticised because of the when the resource project dried up. I got some vicious personal attacks, probably from Globo shareholders on that. And I just said, look, it was always an each way bet. Management, the old management, I think, over-egged it. But anyway, that so we stayed bullish on it because the core business is very nice, and it's turned out that was the correct stance. Very nice. As you say, they have very good results. We reported on a couple of days ago. P is only about 10, but as you rightly say, they had a bit of a bumper one-off boost in the most recently reported years figures, and they're trying to keep expectations grounded for the current year. But as you rightly say, this Vietnam footwear factory sounds like it's going to be a pretty major project. I don't know whether you've asked Cockney Rebel about it, because I think he was quite keen on this a while ago, and he did some digging into the Vietnam and thing, and he reckons that could be quite a big project. So yeah, we like it. We think it's good, sound balance sheet, interesting business, definitely.
Yeah, you're right. I mean, Richard Crowe, Cockney Rebel, loves it, and the one thing one thing he's the extra bit of insight that he adds is that actually Nike as a whole, with its shoes, its athletic shoes and its basketball shoes, are not doing so well. But they don't supply all of the footwear which goes in Nike. What they supply is the running shoes, and the running shoes are flying off the shelves. They're doing really well.
It's the real high-end stuff, isn't it? That makes you sort of bionic or something.
Yeah. So yeah, I'm with you. I think it's a good, solid. And I think we spoke, didn't we, to the CEO? He's a really good guy. Ronan Cox, I think it is, isn't we? Yeah,
that's
really sound guy.
Irish fella, wasn't it? Yeah.
Come from Coates. Yeah, knows his onions, basically.
Yeah, no, I like it. I think it's just a good, solid company, but with some nice growth stuff in there at a nice, reasonable valuation, cheap valuation even, sound balance sheet, nice newly invested factories. I think they did a lot of capex over the last 4 or 5 years. Nice business, Zotefoams. Yeah. Okay,
good. Quick one on we've got DDT4 Real. He's asking about Somero Enterprises, which does basically these screeding machines that help produce sort of like really flat floors for data centers, for warehouses and this sort of stuff, mainly out in the States, I think. Shares have been a bit like its products. The shares have been pretty flat, actually.
Yeah, no, we've called on this one, I'm afraid, because I mean it was a lovely value share for a long time, but last September we've dropped it from amber green, which is moderately positive, to just amber, so neutral. Reason being that the profits are falling, and they give various reasons or whatever, but we think with a major infrastructure boom going on in America, they should be trading their socks off. So what the numbers, the reduced profit is saying to me is that they must be under competitive pressure. They've got to be. I don't know who it is or to what expense, but the numbers are saying to me this is not as good as it was. So for that reason, I'm now neutral on it. The divvies was cut 40% as well, and the main reason to hold it really was the cash flows and the divvies. I think the upside on the shares could happen if they start to report a resumption in revenue and earnings growth. That's the key, isn't it? But at the moment, all the figures are going in the wrong direction, basically. So for that reason alone, I'm just neutral on Somero.
Yeah, I'm with you. I think their competitive moat is declining. I think they need to add.
It looks like that, doesn't it?
Yeah, I think they need to add new products onto it to basically lift that sort of like their USPs. I think their competitors have started to catch up, and once that happens, then you need to generate that extra margin. I think you've nailed it. Okay, good.
Yeah.
Let's move.
I mean, the trouble is it always made very, very high cash flows and cash generation, which of course attracts competition. That's the thing people forget.
Yeah. Good. Okay, final one. We've got James asking about Eagle Eye. Basically, these guys do software to the promotional sector for sort of supermarkets and other retailers, largely for people like they do a bit for Tesco's. I think they do Morrison's, and they've been winning. The big growth engine of late is they've been winning a lot of deals out in the States. In fact, I think they've in the first half results, they came out with an extra 10 customers through direct sales channels, partners, and also increasingly their big channel partner SAP, who has integrated the software within their own in their own enterprise software stack. Any quick thoughts on it at all?
Yeah, I mean, we've profits as we thought. It's like a game of snakes and ladders. They hit a snake, didn't they, and went right back to zero basically on profits, which we knew, and that's what happened with the H1 results that came out yesterday, actually. But you're right. I mean, the bull case is all about the contract wins, isn't it? It's that, okay, yes, it's gone right back to zero, but it's going to rebuild quite quickly based on the good deal flow that they've had, and the SAP relationship progressing could be interesting. I think personally it's not for me. But I think 100 million market cap is, if anything, being a little generous, particularly as the software sector, valuations have crashed right back, haven't they? But interesting company. I don't want to sound negative on it. I'm just sort of giving a nuanced view on it. But you tell us the bull case, Paul, because you're much more keen on it than me, I think.
Yeah, I mean, I actually spoke to the CFO and the CEO earlier after their results, and I quizzed them first of all about the, what could potentially be the impact of agentic AI, and they are clearly in the net beneficiary, because they said, look, okay, we're pretty much entrenched with all of our retailers. We connect with that through APIs for their Eagle Air package with about 8 or 10 major systems to collect data, to create it, to do these personalized promotions to individuals. So we're pretty much in there. So we don't think we're going to be undermined by vibe coding, for instance. And then they're already in with massive sort of AI applications they're putting in, and they're further on personalized side, and they're further adding on that as well. They're putting in probably in the next 12 months, they're going to do this sort of niche audience type of promotions that I think we run off sort of viral marketing campaigns by to get groups and people like that involved. Okay. So they've got a good pipeline. So I think they're going to be a beneficiary, and they're well entrenched in terms of the AI. Then I asked them, okay, well, if we go for a slowdown, how would that impact your customers? Because most of the revenue is obviously, consumption based. They generate revenue when their clients generate revenue. Well, actually, because he's an ex-guy from Unilever. He used to work there back in the 70s. Masterson Wolsey was saying, well, actually, what happens is that essentially the big brands, for instance, they have to then move marketing spend above the line to below the line to sales to help effectively their retailers shift their products, the likes of Magnum ice creams and Coke and stuff like that. Now, and the reason is you do that to improve your promotion. So they should be pretty recession resilient if we go through a downturn, because more retailers are going to be demanding from their suppliers, their brands, money to run promotions. And if you run promotions, you've got to have the vehicle to do it. So and then at the end of it, I asked them sort of because they've got quite ambitious growth forecasts, and they're trying to hit effectively double revenue over the next 4 to 5 years. And the addressable market, as the CFO was telling me, is pretty much there. The opportunity set, they can see it. And it's going to come down to actually, appetite and upselling into their existing customer base and how much SAP can do. But just disclose, I'm a holder of the shares. I'm still very positive on it. And if they can get anywhere near where they think they are, this will be 10 quid plus, as I mentioned, when you do the numbers afterwards. But there's a long way to go. And they did lose that contract, but that was obviously for different reasons. So
it wasn't any failing on their part. That should be emphasised. It was a unique situation. Yeah, it's a very interesting company. There's no doubt about it. So I'll watch with interest. And a lot of companies are talking about AI in a performative way. I saw a commentator saying, who did a study, and apparently 40% of US companies' comments on AI is performative with no substance behind it at all. They're just saying what investors want to hear. Whereas with Eagle Eye, I remember listening to podcasts with them going back several years where they're all over, not large language models, but over the machine learning algorithms that they've really pioneered. And so with them, I do think Eagle Eye's talk about using AI and machine learning is 100% genuine. That's basically what their business is built on, isn't it?
Yeah. No, I would agree. All right, guys.
So I think for that. Sorry, I was just going to say, for that reason, I think you're right. Probably more upside on AI for them than any risk. So sorry, I butted in.
No, that's all right. No problem at all. Thanks everyone for your questions. Thanks again, Paul, for all your comments. And I'm absolutely chuffed to bits with no technical issues this week.
Yay!
I know. Long may that continue as well. So thanks everyone. Same channel, same time next week on Wednesday. So thanks again, Paul.
Yeah, thanks, Paul. Thanks everyone. Bye.